that, welcome to the LPG panel. And with us today we have the CEO of Navigator Holdings at the end, Zacho. And in the middle we have the CEO of BWLPG, Mr. Onarheim. And then we have the CEO of Dorian LPG USA, John Lycouris, joining us today. So with that, I've already gone through what I believe is the easy take on this, and it's that it's energy shipping in a very tight energy market globally. Somewhere that can be very interesting to me, and quite easily enough, there are two main sources of LPG, the way we see it, and it's the US and the Middle East, which are the two main providers of volumes here, which dictate a lot of the shipping demand. And to start off, US LPG production, I thought we'd start off with that, the outlook for how that production is going to develop near term, given the constraints on equipment and investing from the energy sector, and also if there are any, do you see any problems in terms of the infrastructure and bottlenecks to get those volumes to the market? And if we can start with that, and you first, maybe John, to start off.
Sure. Thank you, Jorgen. Thank you for the introduction. Yes, US LPG production has been going extremely well this year. We've seen strong exports and strong production numbers. We expect that the growth of the production this year is going to be around 6%, and we also expect 2023 to be about 5% as well. So the fractionation capacity is at full tilt. Almost 100%, and but new and additional fractionation capacity is coming every quarter from now on into 2023. So we're going to have plentiful of capacity in fractionation, and then I should talk about piping the product. NGL piping the product from the Permian in particular has been already built and is already in position, so we have a good throughput of NGLs coming down to the Gulf Coast. So generally, it's a very good scenario for increased export capability from the United States. We know that a lot has been done at Marcus Hook with their pipeline. Those pipelines have come also online, so they have been able to export significant amounts from Marcus Hook. I'm talking about energy transfer, and so we see a generally extremely positive production scenario for LPG. Of course, this is helped by the production of crude oil and LNG, and that produces enough LPG for the petrochemical industry and for residential and commercial, which goes to many parts of the world. The same thing we have seen also in the Arabian Gulf, but we'll talk about that later.
Yeah. And Anders, do you want to chime in? Is there any? Do you fear the slow response seen in the U.S. oil and gas production activity, or?
No, I agree. I think we are much more confident about the volumes from the U.S. also. I think, as John says, we expect growth in 5-6% range, and to us that's fine. And we don't see any problem with the capacity either. It's at the moment we think there's plenty of capacity. So and of course our business is so dependent on the U.S. volumes. It's also so we're quite comfortable. Now, since John answered so eloquently, I'm going to make another statement. I think, and I want to make sure everyone here understands, LPG is actually a great product, a fantastic product. And even though our keynote speaker forgot to mention that it's also a good alternative fuel, but I think in the context of this, we're also seeing that we can make a difference. And no question, we are dependent on good production in the U.S. And of course, the oil price has helped us. Natural gas, price have helped us. And as long as we see, great demand for LNG, that's going to help us also. So long answer, but yes, we are comfortable with the outlook for the U.S.
Great, thank you. And Mats?
Yeah, I'm sorry, I have to agree with my fellow panelists here. I mean, there's every incentive in the world for the producers and for the infrastructure providers to continue investing into this. The demand picture looks great. Europe needs more energy, and there's a turning to the west from Europe, and that means to North America for the energy requirements. So there's a very good, robust, long-term demand picture here that is a good backdrop for investing into that sector. So, and yeah, LPG has lots of uses in energy or as industrial components. So it's versatile. So it's a great commodity.
There's a lot of talk about these bottlenecks and the infrastructure in LPG, and Navigator, of course, they're part of this joint venture with Enterprise on a terminal for ethylene exports out of Houston. How has that venture been for you, and how is the growth potential there in terms of volumes finding its way to sea?
Oh, it's definitely been a venture that has performed above expectations. I mean, it was very quick, or it was on time, on budget in terms of the building of the infrastructure, and has ramped up relatively quickly during 2020 and 2021. So it's already been running at full capacity most of this year. So it's been a great experience. And when you listen to Enterprise, our joint venture partner, in their external announcements, there will be expansion of that capacity in the years to come. And we, of course, look forward to having that discussion and are participating in that discussion with Enterprise now. There's super potential in terms of ethylene export out of the US, because it's very, very cost competitive compared to the rest of the world, and their scope for expanding it with this new terminal. So we are very excited about that opportunity.
And another thing to mention, historically, I think we looked over the past 20 years in terms of demand for LPG in the US has been flat. So I guess what we're saying is that any additional production that may come should find its way to sea, which makes this an incredibly interesting story in terms of the oil and gas development in the US, of course. And then switching a bit away from the US and onto the other major exporter, Middle East, would you like to say a couple of words on the resurgence in volume that you've seen there, and what the impact that has for LPG shipping? Anders?
Oh, clearly we're seeing the resumed growth from the Middle East, and of course both Saudi Arabia and also Iran has been providing lots of volumes, and of course that's clearly helping also the total market, and so with both the U.S. and the Middle East providing good volumes, that's also making, again, our concern much less for next year, given that we still have an order book coming of some 20%. So, and we expect that to continue. We expect further growth also next year from the Middle East, and of course, if we do see some lift of sanctions from Iran, that could also provide some very interesting dynamics in the shipping business for us.
So how, maybe you want to give some more flavor on that, John, on the Iran side. How much would that add in terms of size, and just what sort of impact could we see with that day when those sanctions are reversed?
I think this year Iran has exported quite a lot of LPG, more than 700,000 tons. I think it's a record on exports from Iran. Just the same thing as Saudi Arabia and United Arab Emirates. They, since the reversal of the production cuts, we have seen all these countries export quite a lot of LPG, and I think it mostly has come from inventories, because they were keeping it. They had to, adhere to the production cuts, but this year we have seen a huge jump from Arabian Gulf exports, and nobody was able to explain it, but it was really the production cuts that were lifted that caused this amount of inventory to kind of flow out, and we've seen 15 to 20% increase in the Arabian Gulf exports. They're hitting liftings which were not seen for the last few years, at least, of 80, 90 liftings. That's quite significant.
Yeah, we, at least according to our satellite data, we're up 20% year on year so far. So there's been a massive bump. And of course, that means these volumes need to end up somewhere. And Anders, in terms of the pricing differential, you spoke a lot about that on the Q2 call that you had on the value of LPG in context of LNG. What are you seeing on the demand side, just due to that switching? How easy is that to do?
We're trying to find that out because it's not so clear. I mean, I've actually given our internal team, I said, when I come back from the States, I want to have a good answer as to, where are the opportunities also rising, But of course, a few weeks back, the price differential in Europe between LNG and LPG was 6 times. And of course, that will create some sort of, and of course, as Matt said, I mean, LPG is a great product, it's versatile, it's energy effective, and so we think there's going to be a substantial amount of at least considerations of switching or at least including LPG in the mix of LNG. And of course, at that price differential, it's really going to make a difference. And of course, Europe needs all the energy they can get. So I'm looking for, and I think we should all look for opportunities to see how can we also play a bigger role in Europe, because obviously Russia was not a big LPG exporter, and so the direct effect has not been great for the LPG business. But again, given the situation we see now, we already see quite a good growth into Europe of LPG, and we expect that to continue. So we need to find good solutions where we can actually also really find a way to matter even more in Europe. Because we know in India there's great demand, in China, so all the product can go there, but Europe needs it, so we need to find a way to help Europe also.
And the positive thing, if you look historically on LNG versus LPG, it's always been a premium product, LPG. And the simple reason for that, I would imagine, is because it's easier to handle. So all the infrastructure constraints that you could have getting people over to gas aren't necessarily something that applies to LPG.
Exactly.
So it's an easy switch when things are looking better on an economic basis. And Mats, the war in Ukraine, in the context of LPG shipping, and petchem shipping, for that matter. What has been the effect so far?
It has had very substantial effects, and of course predominantly because LNG from Russia has stopped flowing to Europe, and hence Europe needs to find alternatives, as we just talked about, from LPG. So there are vast effects from that. But we also see some small effects, you could say, in a niche like, for instance, ammonia, that the ammonia that used to flow from Russia into Europe now has to be replaced with something else. And that means that we'll see ammonia flowing from North America and from the Middle East Asia, and that means more ton miles. And that's fantastic for a company like Navigator. Our fleet is very versatile. It can transport pretty much most of the petrochemical gases, and ammonia has grown from being, let's say, on a good day a year ago, we would have maybe 3 ships with ammonia on at any given point in time, but right now we have 9. So it means a full 20% of our fleet is actually transporting ammonia right now, and we think that's going to continue. It's not only because of the food security crisis and the focus on having sufficient fertilizer for the individual countries. We think there's going to be a longer term effect also here, not wanting to be dependent on Russia for delivery of fertilizers, but of course ammonia also has its own growth story in the midterm, from being a new fuel that can propel not only shipping but power stations and other things. So there's a very good and robust growth story in ammonia, and that has only been, you could say, kickstarted by the war in Ukraine, which is a big support to our business.
On the VLGC side, John, has there been any marked change in the trade flows out of US, for instance, following this, more into Europe and shorter haul on the larger vessels, or?
Yes, absolutely. We've done voyages to Europe that we had not done before, as far as Scandinavia, as Finland, Germany, North Germany, a lot of business in the Amsterdam, Rotterdam, Antwerp kind of complex, petrochemical complex. So we've seen a lot of moves, and we should not forget that LPG is not only used for petrochemical purposes or for heating and cooking, but it's also used as a fungible product for LNG. It could, improve the LNG content in BTU and energy. So it is possible to use LPG as an additional enhancement of the LNG stream. And as a fungible product, it is very useful for Europe to be able to, send it through the pipeline, for example, at a certain percentage to the LNG stream. So it really helps a lot. So I think we've seen a significant increase of cargoes going to Europe this year, maybe to the tune of 10 cargoes more than we used to, for example.
Which is not necessarily positive on a ton mile.
Well, it's not necessarily positive, but it does compete with the East, and it means that the utilization of the fleet is going to increase more, because we have not only to provide LPG to the Far East, but we also now have to provide LPG to Europe, which we didn't used to as much.
At least the rates are not indicating that it's hurting us.
Yeah, that's what I was getting at, was really, because I forgot to preface that before we started, that of course the markets today for the VLGCs are in the 40s, $40,000 per day. Which compared to a cash break-even cost of around 20, low 20s. So this is a sector that's already earning money, and with the outlook of more volumes to come, and also potentially positive shifts in ton-mile trading patterns, you're definitely set up for what could be at least good fundamentals on the demand side. So let's get to the elephant in the room, the supply side, and the order book that we have for 2023. We have around 13, 14, 15% of the fleet or so coming for delivery next year. And that's a substantial amount, but fortunately, you can say, if you look to 24, the order book is very limited, so it's very centered on deliveries in 2023. What's your view on that, Anders? Are the regulations that are coming in at the same time going to counter a lot of this? Or how does that order book look to you? I know you've been a bit cautious previously. Are you more bullish now? Or?
The answer is yes. And we have been quite outspoken about that. And in my previous life in the financial services, I looked at the shipping industry, and every time things look good, they ordered a lot of ships, and this time was different, and very seldom it was. And so we have been cautious. But at the same time, with the latest development of the past 6 months, where of course we've seen, the level of energy prices and also the demand, picking up. We're seeing good growth now, both in the U.S. and in the Middle East. So that's going to mitigate to a great extent, I think, the order book. And also, yes, regulations. We estimate that. From start of next year, about 10% of the fleet is going to have to slow down, and that's maybe not more than a couple knots, but still that's quite significant when you start counting it up. So that, and we have of course the Panama Canal inefficiencies there. That's going to also, I think, really balance out the market quite well, because this is last year we can do pre-book slots from the LPG side, and we know LNGs and the container ships they're going to be the ones that are going to pay the most. So we're going to see a lot of waiting and having to make decisions whether or not we go through Panama Canal or we go around the Cape. So yes, long answer, but I think the balance looks much better now, given energy prices, given demand, and also the supply.
And 10% of the fleet is already over 20 years old.
Exactly. Yeah. So at some point, something might happen.
I think if you combine all those factors, there'll be some delays in the deliveries. There'll be some congestion. There'll be some scrapping. There'll be slowdown in speed, and then a very robust demand picture. I think that looks all right.
So that's my thinking as well. You know, if you spread out that order book over 2 years instead of one, it's 2 years of 7% growth in a growth industry, which doesn't sound insane to me. At the same time, you're slowing down the fleet and incentivizing scrapping. So, but okay.
And also, you just remember, I mean, last time, you know, the downturn, then the order book was 40% of the existing fleet. Now
so
it's
this should be manageable.
So,
Yeah, and it's mainly in the large vessel segments. I mean, if you look at the mid-size and the smaller ones, here the combined order book is less than that 20%.
Yeah, I was getting to that because BWLPG and Dorian focused on the VLGC side. If we turn to you, Mats, more on the smaller vessel sizes, how or first you can first talk about the order book and how that looks in comparison, but also, you know, if you want to pin down what's the advantage of your business versus the larger one.
Yeah, no, thanks a lot. I always like to talk about our advantages. If you look at the handy-size order book, it's lower. It's around, let's say, 6% of the fleet on the water. And if you look at the smaller segments below that, it's even less. So it looks better for the smaller segments. So in aggregate, it's perhaps not 20% we're talking about. It's maybe somewhere between 12 and 15 for the overall sector. Of course, there are some substitution between the segments. But we have, you could say, mid-size and handy-size vessels which are quite flexible, that they will be sometimes competing with the larger sizes when the prices are right, but we can move between all the different commodities, between ammonia, between butadiene, between propane, so pretty much all the petrochemical gases, and that's of course nice when, let's say, a situation over the summer when China stopped importing ethylene. We were then able to deploy our vessels, as I mentioned before, to, for instance, ammonia instead. So that gives some flexibility in our trading, that we can offset weakness in one commodity by then instead deploying our vessels to some of the other ones.
Yeah. And then to John, we mentioned the inefficiencies in the Panama Canal, which can be very interesting to look at, especially when you start to compete with the LNG or containers to go through that canal. You're squeezed out essentially to a large degree. Yeah. How are you trading today? If you want to say, you know, how much do you utilize the canal, northbound, southbound, and how does that look in the coming years to you, given that they're squeezing up prices and everything?
Yeah, it's part of our business. We kind of figure 6 to 8 days for a delay in the canal. There are extraordinary situations when the market is very active, that in the first 15 days of September, we have seen all the way up to 14 to 16 days waiting time. But right now, once the big rush has gone away, the days have come back to a lower number of about 6 days. So you have to figure it into your, fixing and scheduling of your vessels. It's all part of counting in the number of days you're going to have to wait, fixing up some slots early on for some of your ships, or having to wait for an opportunity to cross. So, as I say, scheduling is included in our utilization of the vessels.
But do you then ballast through the canal, or is that risky considering the potential waiting time? Or do you have visibility on that as things stand?
No, we ballast through the canal.
Okay.
We ballast through the canal. We go load it through the canal and ballast through the canal. And this is usually with the cost of bunkers, it's not worth doing the long voyages. Absolutely not. Okay.
Looking at the energy transition and finding alternative fuel solutions for the LPG carriers, you're in a position where you have a clean energy carrier on board and can make the case for that as fuel. And I know BWLPG has been at the forefront in retrofitting a lot of the vessels with LPG-fueled machinery. How has that been so far, and what issues are you seeing, and how much does this calculate into an advantage as things stand right now?
No, I mean, we made a big investment into converting, upgrading 15 of our ships, and they're all on water now. We're seeing better and better results of it. Clearly, there are teething issues when you take on new technology, and there's no question we've had we've not been running at 100%, that's for sure. The first couple of months, but we're seeing better and better results, and it is, and we're also seeing, of course, with 15 ships, we are getting a lot of experience. And I'm happy to see that both with the MAN as a supplier, but also our own organization, how they are finding solutions and how we really start to optimize the performance. But we still have some way to go. But clearly at the moment we're getting, we are seeing good differentials. So we're getting well paid for going on LPG. Right now it's $4,000 or $5,000 in differential, and so that's a big difference. So right now we are fixing ships at 50 plus for those ships, and we'll continue to focus on optimizing the performance better. But again, it's so far it's been a great experience, and we see all these ships will easily comply with the regulations next year, and so to us that's been a great success. And again we made the decision to retrofit rather than build new. And we think that's a better decision. Even in this sector, I think reuse is a good name. So we're very happy with that. And we're seeing also customers really starting to pay attention, and a lot of inquiries about. And also, the last thing I'll say is, because obviously when you have a new technology, and I've been pushing my team because we've had these teething issues, so I'm asking when some of our colleagues are ordering new ships with the same technology, are they getting perfect performance? We're not, but no, I hear that also the new builds have some of the same issues, and so I think together we all want to make sure they work better. But it's again we've made great progress. And I was just telling John, the funny thing is the first ship is the best one. That's almost running at 100%. So I don't know how that happened. But,
How about for you, Mats at Navigator? How is your take on that?
Yeah, we're switching between commodities that we are transporting. Hence, it's a little bit harder for us to define, you could say, an alternative fuel like LPG to run on. We have a couple of ethane capable ships, dual fuel. So I think that's there's some opportunities in that. Of course, what I look very much forward to is to start building ammonia fueled vessels that will transport ammonia. That's not right now, but I think a little bit down the road, and we start hearing the first requests from customers that want to explore this. This would be an optimal way of doing it against a long contract. So I think there's some potential in that. But you could say for our tram shipping business that is switching between commodities, it's not so easy to retrofit them into dual fuel alternative fuels right now.
Are you opting for dual fuel retrofits, John?
Oh, we have 4 coming up. 3 chartered in. We kind of agreed that we do not want to order more ships. So we're just building 1 ship, and we've chartered in 3 dual fuel. So I think that's 20% of our fleet is going to be dual fuel next year. So that's a step in that direction. Also, I wanted to say that LPG as a fuel has just come out this year. The first few ships, I think BW was the first that had a ship on the water in late 21, or maybe the third quarter of 21. And so they haven't been even had a chance to go about it. There's hardly a year that LPG engines have been operating. So it's a little bit early to say what happens with those engines, and we're all kind of learning. We are on a learning curve, and I think LPG engines will have, once they kind of settle in, I think they'll be preferred to LNG engines at some point in the future, because not only because the fuel is easier to handle, but they may be more advanced in design and cheaper to operate.
Okay.
But we'll see how it goes.
No, exactly, because right now there's a lot of dual fuel LNG ships out there that have no benefit at all from the LNG because it's too expensive. So I think again, and as I said earlier, I think LPG is kind of not understood by all and not so well known. Of course, we're a small sector. We're not that many companies listed, but I think the potential for also other shipping segments to look for LPG as a fuel is quite interesting. And you know, and I think I agree. I mean, with Mats, I mean, ammonia, of course, when if that's ready, that's great. But it's going to be that's some way out. And so I'd actually, is there anybody out here who's has ships and they want to go green? You know, try LPG.
Yeah.
So finally then, before our time is up, I want to touch a bit on valuation. And I think we cover 3 VLGC companies, so in that sphere, as I said, the peer group is 30% discounted to the steel values in the assets that you have. It's a steeply discounted sector. And I was going to ask why, but I think you touched on an important point, Anders. It's maybe a bit to do with the complexity. It's a bit difficult to wrap your head around necessarily, but I'll give you the opportunity, Mats, if you want to angle that easily and package it for investors. You know, what should we follow, and what makes this an easy sector to grasp?
Yeah, I think ultimately the evidence needs to lie in us and our ability to create returns to the shareholders. If you have a long period of time where the investors look at the stock and say that there's not really much return delivered and we don't understand the complexities of the industry so well, that's a tough sell. So I think the best way to show the investors that this is a good industry to be in is to deliver those returns. And I think here the prospects are looking pretty decent. And the good thing, of course, is when you're trading at a discount that deploying some of your excess capital by doing share buybacks or similar, I mean, that's a easy decision to make. So I think there's some opportunities in that. And with the cash that's being generated in the sector right now and with the outlook, I think that should be a good opportunity.
And I'll leave the closing words to you, Anders, if you want to follow up on that.
Yes, I do want to follow up on that. I just ran since our IPO in 2013. I just ran the numbers to see which sectors have performed given the highest return on equity from 2013 until today. And surprise, surprise, LPG comes out first. We've delivered 15.5% return to shareholders since the IPO in 2013, and we still trade at the lowest valuation. Now, I think one of the reasons is people believe that our market is not liquid, the asset values are not, that they can't be documented. We've sold 19 ships the last 3 years, above book value, net asset value. So I'm happy to buy back shares, but I also want to make sure that the investors have an opportunity to participate. So I would definitely look at, I never recommend my own stock, but I think, again, the Dorian advance looks really attractive.
Okay, I think we'll leave it at that. Thank you very much, everyone.